Welcome back to the Biff Mini Bites video series where we take 5 minutes to discuss each of the most important CFP exam topics. I'm Mike Long from the Boston Institute of Finance, and in this mini bite we're going to take a look at a topic called net unrealized appreciation, and this is an important topic for retirement/income tax. And it has to do with the special tax treatment a client might have available when taking a lump sum from a qualified plan. You see, qualified plans are allowed to invest in employer stock, in company stock. It's very limited in pension plans. Not more than 10% can be invested in employer stock, but it's unlimited for profit sharing plans. 100% of the profit sharing plan could be invested in employer stock. That might be a traditional profit sharing plan. That might be an ESOP. It could be a 401k plan as part of a profit sharing plan, but it's unlimited 100%. So let's look at an example of that. So we have a profit sharing plan, and perhaps the client's been in the plan for 30 years, and it's funded 100% in employer stock. And over the years, the employer has contributed stock on behalf of this participant in the amount of $100,000 aggregately. That's called in this topic employer basis. But also, this many years later, this stock has appreciated by another $300,000, and that's called net unrealized appreciation. So combined, we have a total account balance of $400,000. So let's take two looks at a lump sum distribution from this account. On one side might be the more typical distribution, and that's where everything just comes out all at once. No special treatment, no special elections, and it's all taxed at once. So here we would have $400,000 taxed at ordinary income tax rate, unless it's employee basis in the plan. Distributions from qualified plans are always taxed at ordinary income tax rate. So that results in $140,000 of taxes, so there's $260,000 net for the client after the lump sum distribution. But because this plan holds employer stock, it qualifies for a special distribution election called NUA election, and it can save the client a lot of tax. And what that means is that when this stock is distributed in a lump sum, that employer basis of $100,000 is taxed as ordinary income. So we've assumed in this example a 35% marginal tax rate, so we would have $35,000 in taxes as ordinary income. But then the client is holding the stock, and then at some point in the future they sell the stock. That will be taxed as long-term capital gain. So we have $300,000 taxed at, we'll assume 15% here, so there's only $45,000 tax on that $300,000 of appreciation. And the cool thing is it doesn't matter whether the client holds that stock after the lump sum distribution for 1 day or for 10 years, it is forever long-term capital gain on that $300,000, on the $300,000. Now, if it appreciates further than that over the years, then that's going to be short-term or long-term, depending on the holding period after the distribution. But I want you to understand here what happens on that original $300,000 of net unrealized appreciation. So the client nets, in this scenario, $320,000 because we only had the $35,000 of ordinary income tax when it was distributed, and then later when it was sold, we had $45,000 of long-term capital gain. So the client nets $320,000. That's over a 20% improvement to the client's bottom line. So anytime we encounter a client that participates in a profit sharing plan, we need to always ask if there is any of it invested in employer stock, because the client would be eligible to take NUA treatment and save a bunch of taxes. All right, so thanks for listening. The full mini bite video series and other great study resources, including our really popular Biff Bites podcast, can be found at biffbites.com. And we hope you'll use them and enjoy them. And as always, study on, my friends.